Futures contract rollovers in the European context. European participants primarily access precious metals futures through two exchanges. The London Metal Exchange is the dominant European venue, offering physically and cash-settled contracts for platinum and palladium via London Metal Exchange bullion, using the London Bullion Market Association prices as reference. And the Chicago Mercantile Exchange Group, comprising COMEX and NYMEX, which is the global benchmark for gold and silver futures, is widely used by European participants, with dedicated spot spread products to bridge the London over-the-counter market. Here's how London Metal Exchange contracts work. London Metal Exchange futures contracts are an agreement to buy or sell a fixed amount of metal for delivery on a fixed future date at a price agreed today. The London Metal Exchange cash-settled futures range allows participants to trade monthly prompts out to 15 months. All London Metal Exchange contracts are traded in lots and are priced in US dollars, though the LME publishes official exchange rates to enable settlement in pound sterling, Japanese yen, and euros. Rollover mechanics. A rollover occurs when a trader holding a futures position near expiry closes that position and simultaneously opens an equivalent one in the next active contract month, maintaining exposure without taking physical delivery. Here are the key considerations for European participants. Timing. Most rolling activity concentrates in the days just before the front-month contract's first notice day or expiry. For COMEX Gold, this is typically around 2 to 3 business days before the month end. Roll cost, contango, and backwardation. The difference between the expiring and next month contract price determines the cost of rolling. In contango, with the far month priced higher, rolling costs money. However, in backwardation, the roll generates a credit. Unlike monthly COMEX contracts, the London Metal Exchange uses a daily prompt date system, allowing delivery on any business day up to 3 months in advance. This gives European hedgers more flexibility, but also means rollovers can happen on a rolling daily basis rather than at a single monthly expiry. Cash-settled alternatives. London Metal Exchange cash-settled futures provide the industry with risk management tools even when physical settlement is not suitable or cost-efficient, and they operate more similarly to other futures markets, benefiting traders and the investor community. Recent developments. Platinum futures were the standout performer of 2025, rising nearly 130%, driven by investors diversifying portfolios and hedging inflation. The Chicago Mercantile Exchange Group also launched a new 100-ounce silver futures contract to improve access for a wider range of participants, sized at 1/50th of a standard silver futures contract, enabling larger positions with less upfront capital. Platinum Group Metals continues to trade on a distinct set of fundamentals compared to gold and silver, behaving less like monetary assets and more like industrial commodities with specific supply-side constraints, offering a different value proposition but with exposure to the cyclical risks of the global auto industry rather than the macro-hedging properties of gold. In summary, Europe's precious metals market is driven by a potent mix of industrial demand, especially automotive, platinum group metals, and green hydrogen, investment flows, and central bank activity. All are underpinned by import-dependent supply chains under geopolitical scrutiny. For traders, the London Metal Exchange and Chicago Mercantile Exchange offer complementary role structures. The London Metal Exchange's flexible daily prompt system suits physical hedgers, while the Chicago Mercantile Exchange Group's monthly contracts and new micro-sized products serve a broader investment audience. Roll costs and timing are critical, particularly given current contango structures in platinum and gold. Thanks for watching.